the best decisions for you. If you have questions, please contact your investment advisor. Please read through the rest of this, and then we will get into the good stuff, the actual education. All right, hopefully that gave everybody just enough time to read through this and do the legal part of this, which I'm sure many, if not most of you, have seen something similar already in the past. For those of you that are not familiar with me, here's a quick personal bio. I'm Keith Harwood. I started my career in the option pits of the CBOE before the subprime crisis. So I graduated from the University of Notre Dame in 2005. My major was in theoretical mathematics and economics. For those that don't know, that would have never gotten me into the pits back in the 90s. They wanted big guys that could kind of push their way around. Fortunate for me, switching to market makers, which now are all PhDs, I was in that perfect transition point. More of a theoretical mathematician, people that are quick with numbers, transitioning from fast markets and using computers to the full computer stuff right now, which is, frankly, it's, a lot of PhDs and a lot of just computer programming, which is actually good for us. The reason I say that is that as I was a market maker, we went through the subprime crisis, which many of you may be familiar with. For those of you that are not, I'd look back and look at it. Markets got pretty wide, great for the market maker, not necessarily so good for the retail trader. When the bid-ask spread is wide and people send market orders and it trades on your bid or your ask, the market maker is the one making the money. So if he says that he thinks an option is worth $10 and he's willing to pay $8 to buy it or sell it at $12, it may not sound like a lot, but when you multiply it by the $100 per share or per option, $4 wide is $400 wide. There's a lot of money to be made for that guy. As we came out of the subprime crisis, we also had this big revolution towards everything being much more computer focused, tightening up markets, focusing on volume. The VIX dropped, back down towards low teens. Of course, we had some spikes in the last year or so because of things like COVID and the trade war with China. Who knows what's going to happen in the future? But right now, we've still got tight markets, great for the retail trader, as long as we know how to take advantage of it. So looking for the edge in the market that is not market width. As I started seeing those market widths collapse, I wanted to get away from that too. I didn't want to be a market maker if my entire game was just sitting there saying, okay, I'll buy 3, I'll sell 3, I'll buy 7, I'll sell 2. Oh, no, I'm long 5. I don't know what to do with these. Get rid of them at the end of the day. Lo and behold, I broke even for the day. That's not a great system for an individual that wants to try to have an edge over the marketplace. I went and got my MBA from the University of Chicago with a focus on analytical finance, entrepreneurship, and econometrics and statistics. Ugh, it's a tongue twister. Basically math. So I got an MBA with further mathematical, analytical stuff. The reason I really did that was to try to leverage myself into getting out of a position of having a neutral bias on everything and start thinking about how to have a stronger bias on the direction of markets as well as the direction of volatility. My now 15 years of expertise, I have a really strong background in the direction of volatility, as well as the term structure and skew and all these other things. But until I could get to a hedge fund, I couldn't do directional bias. So I went to a hedge fund, a CTA, Commodity Trading Advisory, generally known for their technical signals. So I don't do fundamentals, I do technicals. I know the fundamental backdrop, but everybody knows the fundamental backdrop if you just watch the news. That's the fundamental backdrop I know. I don't sit there and dive into some companies' financials and say, okay, I found the little tweak that's going to make them extra money. I let somebody else do that, start the flow of the market, and then I try to get on the same path as they're taking it. So I use options with technicals to create opportunity. It worked well for the hedge fund I was with, but I left it because what's the point of sitting there trying to make billionaires their next billion? It's not that rewarding. What is more rewarding is trying to prevent those people that just, need that extra little oomph or an extra little piece of information from making a catastrophic mistake or even a minor mistake. I'd rather help everybody else make a little more money. Of course, that education is why we're here. I provide a lot of stuff for free. Of course, I have to make a little money along the way, and we'll talk about some of the programs I offer that help me make money, but also help, hopefully, you guys make more money. And with that in mind, let's talk about what I'm already seeing for 2021 based upon what happened at the end of 2020 and also the last week and a half of the year or 2 weeks that just started that's already going crazy just like 2020 did. So if you have to leave early, email me, keith@optionhotline.com. I'll answer. I don't think I've ever left an email unanswered, but maybe I missed one. But at the same point, if you do have a question and I don't answer, email me again or call me, 312-600-8004. Most people don't want you to call them because they don't want to take the time. I try to make myself as available as possible. If you are interested in anything further, education or content or products, that's why I'm here. I don't want you guys to feel left out where you say, okay, I signed up for something and now Keith's ignoring me. Not the case. You sign up for something, you send me an email, I'll respond. Even if you haven't signed up for anything, I will do my best to try to answer your questions. Sometimes there's only so much I can answer, but everything I can, I will do. At the same point, keep an eye out for webinars at optionhotline.com to receive the free giveaway that we talked about. I believe it was the 5 Indicators ebook. That's going to help you hopefully with some of your technical trading signals. Okay. It's also stuff that I use for the program that I'm going to mention in probably about a minute and 10 seconds. What we're going to discuss today is why I use options first. I always lead in with this. Some of you have already seen these slides. Don't worry about it. We're going to go through them. I need to make sure everybody understands why options provide leverage and defined risk. For those of you that already are familiar with options and haven't seen it, it might provide a different perspective than you've already had. For those that have already seen it, maybe I'll throw in something new. I don't actually know. I mean, I just talk about options all the time, so who knows what I said last time. We're going to talk about investor philosophies for the new year. Many of you may have seen my webinar about a month ago where I talked about investor philosophies for the end of the year. Now we got to talk about what they're doing in the new year. We're going to talk about how short-term options play into that, but the real focus right now is what long-term trends are starting to kick in. And because of that, I'm going to then talk to you guys about what sectors I'm watching and where I'm looking to generate leverage in the options market for 2021, just given these initial signals in the last 2 weeks and or maybe 12 weeks. So in the last 2 weeks, we've had a lot of shifts. In the last 12 weeks, we've had many more. That's what we got to look at. That's how we try to outperform the markets. So I mentioned Option Trend Trader. I mentioned the programs that I run. Option Trend Trader is a trend following system focused on stocks within the NASDAQ 100. So I do not trade the NASDAQ 100 itself. I trade the underlying equities. I use options. We'll talk about how I structure that a little later. But you can see the performance from 2020. Yes, the NASDAQ had a very nice return, nearly 50% on the year. Option Trend Trader was just under 150%. So on a $20,000 account, the total profit was something like $29,500, plus or minus. Don't quote me exactly. I'm giving it a ballpark within $100 or $200, but we're talking about some serious leverage on the trends. That's the goal. We're always looking for ways to leverage the trends and to find the opportunities. So let's do options first. Options have risks. There are increased transaction costs. You have the risk of assignment when you are short an option. In this program, I do not sell options. It's all long options. A lot of you might think of options as a way to collect income. That is great. It is a good strategy. What I'm presenting today is all about buying options for leverage and defined risk, not selling options for income. Very different strategies, both very valid. Everybody has a different style. We're going to be talking about buying options today. Okay. Next, options decay in value over time. So because I'm buying options, they decrease in value over time. If a stock doesn't move, I can lose money. But if a stock doesn't move, I can also make money because volatility can rise. Traditionally, implied volatility does not rise when a stock's not moving unless an event that is a surprise to everybody is coming up. But you never know. Implied volatility is a huge factor. It tells you how much we think that the stock is going to move going forward, and thus has a major impact on the option valuation. So never just fully disregard volatility. We will talk a bit more about why volatility matters for some of the strategies I use later, but keep that one in mind, keep decay in mind, and also keep transaction costs in mind. That's fixed by your brokerage firm. If you have questions about where they are, call them. But the two that we have to focus on because of the strategy I'm using today is really decay and volatility. So why I use options is really just all about looking at how a stock performs versus how an option performs. So this is how a stock performs. If I have $10,000 that I want to invest into a company, I can buy 100 shares of that stock if it's priced at $100. Completely theoretical stock. I don't know what current stock is currently trading exactly at $100, but there's probably one out there. But if you have that stock sitting at $100 and you want to buy $10,000 worth, you would spend $10,000 to buy 100 shares of stock. You have unlimited upside. If the stock goes to 120, you make $20 a share, $2,000. You have unlimited downside. So even if you tell yourself that if the stock goes to 90, you're getting out, sometimes these stocks go from $100 to 60 without having a print in the trade anywhere between. That's a risk. Do not ever assume that you can always exit at your targeted stop loss. It could be an exit at $88 when you wanted to get out at 90, could be at 82, it could be at 30, could be at 0. In theory, a stock can go from $100 a share to $0 a share. There are very volatile names out there. I don't expect a stock like Apple, which is basically the biggest company, or Amazon or Tesla, any of these names, although Tesla is very volatile. I don't expect any of them to go to 0 overnight. But if you start getting into some smaller names where the market cap's a little lower, you never know if like an accounting issue is going to come up and just absolutely destroy the stock. So always be aware of that. Because that exists, I like call options if I was going to buy this stock. So here's my counter trade to spending $10,000 with $1,000 of risk. I can spend $1,000 with $1,000 of risk. How do I do that? In this theoretical stock, assuming implied volatility is at the right point where the at-the-money call costs $5, I can buy 2 calls for $5, representing 200 shares of stock to the upside and 0 to the downside. How does that work? A call gives me the right, but not the obligation to buy the stock, which means that if the stock goes down, I don't have to buy it. If the stock goes up, I certainly want to buy it for $100. That means that if the stock goes to 0 overnight, I lose my $1,000, nothing more. If I sold a put, I would be forced to own the stock below, and I would lose more money than I thought. To the upside, the benefit here is that I'm buying 2 calls, which give me 200 shares of power to the upside. So instead of representing 100 shares at a price of $120 for a $2,000 profit, I would have 200 shares, which would mean that these options are now worth a total of $2,000 twice, so $4,000, minus my initial premium cost of $500 per contract, or $1,000 total. What that means is that if the stock only goes up a little, I can actually lose money. That's that decay factor. If the stock goes up a lot, I make extra. If the stock goes up a little, I lose, or I lose relative to stock. It's the comparative graph we've got here. At $105, my options position makes me a break even. At 110, options start performing better than stock. If I have a stock where I really think that it's going to go from 100 to 103, it's not an options trade for me anymore. It's literally just buying the stock and making sure that I've defined my risk to the downside. If I think the stock is going to go from 100 to 103, but could possibly go to 0, I'm probably not trading it. But if I think a stock could go from 100 to either 140 or down to 0, and the options are giving me this kind of opportunity, I'd rather be in options for both the defined risk and the leverage. There it is. Remember that valuing an option means that it has 5 main inputs. Black-Scholes is the standard model. Black-Scholes is not what market makers actually use. They use something much more complicated, but Black-Scholes is good enough for most of us. You take the underlying price, which is given by the market, the strike price, which you've selected but is given by the market, the time to expiration, which you've selected but is given by the market, and the risk-free interest rate, which is basically 0% and will be until we're all dead, it seems like at this point. The one input that can be estimated instead of given is the implied volatility. I might have a bias on where the underlying is going, but the implied volatility is me guessing or estimating how much this stock is going to move over the time of my option. So if I think that my option is, or my stock could move 20% up or down in the next month, and the options are implying that it will only move 5% up or down in the next month, I have an edge. My underlying price edge tends to be something like 60-40, where I have a 60% chance of being right using technical analysis. Implied volatility can create a much larger edge than that, but it can also be very risky if people don't realize that buying $10,000 worth of options means I have $10,000 of risk versus buying $10,000 worth of stock tends to have a reduced risk position. Okay. I have a question here already, and I want to just address it real quick. If I'm a buyer of options, can I explain why I use them over futures, which also provide leverage? Futures require me to buy the position at their expiration date. Options give me the right, but not the obligation. So futures position is basically, if I was looking at it for traditionally a commodities thing, if I bought a crude oil future expiring in a month, 1 month from now, I either have to take delivery or close my position. I don't really want barrels of oil in my living room. So I would either be closing the position or rolling the position, but I cannot just let it go unless crude oil ever went to zero, which I mean, maybe they argued for it a few years ago, but it doesn't seem like that's likely anytime soon. And if I'm a buyer of options, at what I assume IVR is an implied volatility. Not sure what the R is, but days to expiration am I buying? We will come back to that in a few slides here. I'm not sure exactly how many. I got like 15 more. So somewhere along the way, I'll talk a little bit about days to expiration and implied volatility, because that is actually dependent on the type of trade I am making. So we've done the little options brief review, whatever. For many of you, that was probably really easy. For some of you, it may have felt like we just zoomed over. If you have questions on it that feel like I zoomed over it too much, go back and we've got my email coming up on the next page again, but also my email, phone number. Call me, email me. We can talk more. Right now, I want to get into the kind of the meat and the current setups, as opposed to that just every day. That's how options work. So what are people doing in the new year? Why are people investing in new positions? Well, there's a lot of different reasons to do it. Right now, there are regime changing ideas and they continue. So people started this up a few months ago after the election results. I mean, the last week has been crazy. I don't like to talk politics, but I do like to be aware of what's going on in politics. So the last week was crazy. We know that the change over from Trump to Biden, assuming all goes smoothly here in 1 week from today, I believe it is, will create different political philosophies that have different impacts on things like the dollar and interest rates and oil prices and sectors and everything else. Just that's what happens when you switch from a Republican president to a Democratic president. There are also regime changing ideas because of this little thing that I'm not sure anybody here has heard of yet, but I'm going to mention it for the first time, if not COVID-19. So that's been around, I believe, for about a year now. It started maybe a little earlier, but people started talking about it more seriously a year ago. Obviously, we've all been, I assume all of us have been pretty greatly impacted by it. And it also impacts companies and how they perform going forward, and how they perform if we do have enough success with the vaccine, or some of the policies that have gone in place and some of the policies that are coming. So that's regime changing ideas. And there are a number more. We don't know what's going to happen next, but every time a fundamental input comes into the market, that changes the fundamentals of every stock. So when we get those fundamental inputs, we start looking at those regime changing ideas once again. There is a massive rebalancing of portfolios that often happens. This is, there's a trading philosophy, basically the dogs of the Dow. The things that performed the worst the year before is what you want to overweight the next year. The reason behind that is because if I owned a basket of 10 stocks and I wanted 10% of my portfolio in each of those stocks, when I got to the end of the year, the ones that performed best might be as much as 20% of my portfolio, and the worst might be down to 5%. So my rebalancing effort mean I have to sell the things that did the best and buy more of the stuff that did the worst. That natural money flow helps create just massive changes in equity and sector performance. We could see that again. Retirement account contributions are always pretty much a positive inflow to the market, creating a net move higher. Some people overload their retirement account contributions at the beginning of the year and are done with it before June. People that are doing that right now wouldn't have necessarily been buying in December, so we may see increased retirement account contributions, creating a little bit more positive flow at the beginning of the year. And then why are people closing positions or selling out of stocks? Profit taking. They didn't want to do it in December because then you had to pay taxes in April instead of April 2022. And fundamental concerns. I can talk about all of them. I kind of touched on them. I mean, there's the political concern right now with everything that's been going on last week or so. There's still the COVID concern. Who knows about anything else that's going to come up? So we have to see where things go. When you see a market that's performed as well as it has, people often get a little lax with their profit taking. And then all of a sudden, as some fundamental concerns come in, there could be panic liquidation events that creates sometimes opportunities and sometimes it creates absolutely nothing. And just, I wish I had closed out every position I ever had. But lo and behold, we'll see where the market takes us this year. And why are people doing nothing? Because that's the third option. If you're not buying or selling, why are you doing nothing? Well, when you don't know the next move, the best thing to do is often nothing. So if you're not over leveraged to the market, you're just looking for a retirement account for 40 years from today. And I don't know if the day-to-day matters that much. Sometimes the best thing I can do is just sit and ride with the current. And that's what we're going to talk a little more about with the trend trading and long-term option stuff in 3 slides from now. Next slide. Short-term options. So this is where I talked a little bit about, I want to talk a little more briefly on this because this stuff is important for trading, but there's a lot of really big stuff coming in the trend more so than the short-term little wiggles. So those of you that are looking for trading opportunities, I have a separate program for short-term trading opportunities. My key here is when implied volatility is extremely low and we hit an inflection point. So a stock hasn't been moving for a while, retouches recent highs. Stock hasn't been moving for a while, touches recent lows, or a stock has just been slowly trading in tighter and tighter ranges. Oftentimes that can create big moves with cheap options. It's all about that inflection point. When I'm looking at and looking for is if a stock basically doesn't have to go home, but it can't stay here. So if a stock really has no reason to stop moving any longer, we finally may have reached that inflection point that requires a movement up or down. I want to look for a leveraged trade that defines my risk. If you have questions about these types of trades, you should email me because we're not going to get too deep in them. The only thing I'm going to do from here on this type of trade is show you sort of an analogy. You're floating down a river. The stock is either sitting or slowing down, doesn't seem to be going anywhere, and you hit a fork in the road, or fork in the river, sorry. Which direction are we going to go from here? If your canoe with no paddle is near the right edge of the river, you're probably expecting it to go to the right there. I don't know what's coming ahead after that. Maybe there's a waterfall and I'm just doomed. Maybe we have a little bit of a move to the left there, get down the other one, and maybe it's just smooth from there on. I don't know. But what I want to do is I want to have a paddle. That's what I try to offer with some of the education I give is to give you a paddle so that if it starts looking pretty scary ahead, you can try to move your canoe out of the river and just walk back off on land, on dry land. So this is short-term options, reaching an inflection point. I know we're not going to keep going straight the way we were. We're either going left or we're going right. And I really hope that it's smooth after we get there. With long-term options, there's no inflection point. I'm looking to ride what is already in place. People continuing the momentum that exists, adding to positions, smooth, we'll say smooth sailing, but what we're talking about is just a smooth current. This is a long-term trend that I'm looking for, like The investment in tech since March of this past year, that's been a long-term trend. Nobody's really selling tech companies. Why? Because people, when they're working at home, need more technology. And those technology companies tend to be able to operate better from home than other sectors, like say retail. If you're not don't have an online presence in retail, you really struggled. If you had an online presence in retail, you probably did okay. We'll come back to that actually when I talk about the short-term trends that I've already been seeing. So it's all about expecting to stay the course and continuing the momentum that already exists. I may not be the first person to buy into the sector, but when I see that everybody's starting to buy and everybody hasn't yet bought, I want to get in too. When everybody's bought, sometimes the story's over. They always say that when you're a dentist or a cab driver, not that we're really seeing either of them right now, start giving you stock advice, it tells you that we're probably at the peak of that particular idea. The reason that people say that is because if all the investors have filtered through it, gotten it to the media is now starting to send it out to every other person that's out there, and they're starting to give you advice, it means that they're probably some of the last people that needed to buy. Nothing against some of you that are, I'm sure, are dentists or maybe even cab drivers. You may have made a lot of money trading. You may have done even better than some of the professional investors out there. But the average dentist or the average cab driver is not as tied into the markets as the average hedge fund manager or investment advisor or trader. So if the market decides to change direction from current flow, that's when I need to have my defined risk. That's why I use options. Using options adds leverage and defined risk from what we were talking about before. Adding stop losses further helps define the risk. So hopefully I don't ride my option down to maximum loss. Hopefully I can exit before it reaches that point. This is my analogy for a long-term trend. A nice wide river. If I have a canoe without a paddle, maybe I'll sway a little towards the left, sway a little towards the right, but I pretty clearly see the direction we're going. I don't want to hit a rock by surprise. That's why I need a paddle. So again, option trend traders, that paddle that helps you guide yourself through the little things and maybe even make you get through those slowing points in the market a little faster, so you can get back to the big trends. Again, I wanted to bring up the option trend trader versus NASDAQ 100 return now because this is again a reminder of how that paddle can help. It can create that leverage. When we have drawdowns, it's not nearly to the magnitude of the upside because we define our risk, because we manage our risk, and because we use the leverage to help navigate these markets. And sometimes that navigation means just managing the risk to the downside, and sometimes it means leveraging those moves up. And I think, Steve, this is you had said you wanted to address something here in the middle, and I thought this would be a good time to take a quick break before I go into the sectors I'm watching right now and why.
Sounds good. Thank you, Keith, and thank you to all of our attendees. And Keith is going to grab a couple of sips of water, and I basically just wanted to share one thing with you, and this is it. This is Keith's Option Trend Trader, and you'll find that on the store, in the store on the Option Hotline website. And as mentioned at the beginning, we do have a special gift for you, which I'll get to in a second. But excuse me, right now you can see in the lower right hand corner, those of you who have a barcode scanner, you can scan that and get a discount on Option Trend Trader. And also, just for attending this webinar, you can also get a $1,000 discount. And if you use the coupon code AmazingYear at checkout for Option Trend Trader, you will get an additional $1,000 discount off of Keith's Option Trend Trader. There are other products in there, and our sort of generic discount is 100 for you. That's the number 100, 100, and then the word for, FOR, and then YOU. But for Keith's option trend trader, use the coupon code AmazingYear at checkout and get $1,000 off. And I believe that's it on my end. Hopefully Keith has had a chance to hydrate a little bit. And
Yeah,
Keith, if you're there, I
I'm
will
here.
turn it back over to you.
Grabbed a couple of breaths and a couple of sips of water, and we should be good to go again. Let me hit the changeover, make sure I get the right screen. Should be that guy. So if you're seeing the option trend trader slide again, then I did it right. If not, please tell me now so that I fix the view here.
Nope, we've got it, Keith.
Perfect. Little reminder. So I'm going to get into some sectors now. If you have questions about the sectors as well, and anything we already covered and how I kind of put it together, feel free to throw it in the Q&A. Again, if I don't get to it during the conversation, I will try to address at the end. So what sectors am I watching and why? This is the new stuff. This is the stuff that I'm really trying to address going into 2021. And this is probably why a lot of you are here. What sectors am I finding new trends? What sectors am I finding some short-term inflection points? So that quick leveraged move. And what new and old long-term trends exist in the market? We're going to start with one that a lot of people have probably heard about if you've been following really since the election, and that's small caps. So the Russell 2000 ETF called IWM represents the small cap stocks. These tend to be, 2,000 names as opposed to the S&P 500, which is 500, or the Dow, which is 30, or NASDAQ, which is 100. So it's a wide list of names. A lot of times financials, energies, some of the retails and stuff can get in here. Since the election, the small caps have really performed well. And on each of these charts, I'm going to try to do a little drawing just to show you what I'm talking about when I'm looking for a trend. So in this case, you just see you got some support here to the downside. Maybe you dipped a little bit below it since November 2nd, November 3rd, and then resistance on the upside. So we're basically touching resistance now. We've had our support to the downside. We may be at a near-term high, but overall, this trend looks good. So what am I looking to do? When we get to the lower part of this trend channel, I'm looking to buy. When we're at the upper part, maybe I'm just reducing my positions, and I'm trying to do this with in-the-money calls. So I'll address that again with Option Trend Trader. We use in-the-money calls. I'll give you the specifics of that after we're done with the sectors, but this is generally the idea of this type of trend. When I find a trend, I use what's known as a triple moving average signal. It's a technical signal that we don't have time to cover today, but I believe is covered in the blueprint, or sorry, the 5 indicators that I send you. Make sure you review that. And if you have questions about what the triple moving average signal does or is, you should, again, email me. While we're looking at stuff like this, there are many different signals that are on my charts. I have the RSI down here. Obviously, we know that IWM's RSI is saying it's overbought. We're touching the top Bollinger Band. That's telling me we're overbought. There's some concern here, but I'm not necessarily looking for IWM to liquidate unless it starts to fail below the trend channel. So for me, I'm not necessarily looking to buy small caps today, but maybe within 3 or 4 days, it comes down to the lower part of the trend channel, and then I buy some in-the-money calls. It's how I generate a nuanced entry into a trend. Small caps don't look like they want to collapse. Small caps look like they want to go higher. And logically, it makes some sense when you think about the last 4 years. Small caps have greatly underperformed tech for years. So if people are looking for a value, they may find them here. Let's clear them all these drawings, and go to the next sector I'm looking at, which was related, oil. So this is USO, which basically gives you a relatively clean picture of how your investment would perform if you had bought the ET or bought the future and rolled it every month. Okay. You can see this red line here is the 200-day moving average. The fact that it's way up here tells you where this was a year ago. Oil was much higher. It cost a lot of money for people that were just investing in oil. But now, over the last, say, 2.5 months since the election, oil continues to go higher. I'm not going to look too much on USO here because I'd rather look at the sector for the stocks, and that's XLE. This is the probably most well-known. There are OIH, XOP, and others. XLE, though, has some of the biggest oil names in it, and you can see that it had a very nice recovery, I guess you could call it, from the election, all the way up to, from 30 all the way up to 40, about a 35% return in a matter of weeks, consolidated, and now is starting to break out. There's two things that I'm seeing here. Number one, we had a little bit of consolidation here. Oops, that's not a great drawing, but you can see what I'm trying to capture is this consolidation that came in at the end of the year, around the holidays. And then when we started trading above it at the beginning of the year, that was one of those inflection point trades. But now we're looking at probably just going back into a trend resumption phase. So I'd be looking here for individual names to execute on my trend following system. Let's clear them all again and go to the next guy. I told you retail doesn't sound great in a global pandemic where everybody's required to stay home, but it turns out everybody seems fine with it. Ever since, again, the election was just like this big inflection point for a lot of sectors. Retail has just been going higher and higher, and you can see there's very little dip. It had a little bit of consolidation in December, but this has generally been a very good performing sector. So what do I want to worry about here? The RSI is way too high. We're up at the upper Bollinger, but when we start to dip down, I can get in this trend. I don't want to buy at the extremes when I'm following a trend because I'm not looking for a leveraged move to the upside. I'm looking for a move to the upside over time. So if I get in at 72 for a move to 78, that's nice. That's still good. But if I can wait for a dip back down towards 68 instead of 72, those percentages matter on the trends. So I'm looking for dips to buy. This is what I'm looking for in general in a trend following system. Now, all that is great, but what we're here to talk about today is tech. And the reason is that tech has been king for years. Tech has just dominated the performance of the stock market. And when you look at the NASDAQ, the trend is slow and steady to the upside right now. We had a big run up back after COVID shut down everything, but really recently, it's been pretty slow and steady. And if I highlight really from the election up, we had some time at a little bit above, which maybe this is a little bit low here to do the trend channel, but we've gone from about $290 up to $315. So 8 to 10%. That's a decent return. It's not nearly the magnitude of what we've seen recently in energies for those quick hitters that are now starting to create trends, or retail that has turned a quick move into a trend, or small caps that turned a quick move into a trend. This is a sustained trend that has existed. So for me to make money in the NASDAQ, what I have to do now is find the right stocks. So I told you, an option trend trader, I am always looking for what are the right stocks. What stocks are people buying? They're not buying every tech stock. They are buying the ones that they think will outperform tech and or the general market. So if a lot of the value right now is in energies or retail, or financials, there's still going to be value in tech. It just may not be in Apple. After this presentation, pull up a chart of Apple. You'll see that it hasn't really gone anywhere. It may not be in Facebook. Facebook has not done well at all over the last week. Where it may be is in some other smaller NASDAQ 100 names that just fly under the radar. In fact, when you look at tech with a different ETF, and that's XLK, you'll see that it's kind of underperformed here this last few weeks. Why is XLK, a tech ETF, not moving as well as QQQ, a tech ETF? QQQ moving higher and testing new highs there. XLK did not make a new high a couple of days ago. Well, the answer is that the components of these tech ETFs, NASDAQ has 100, XLK only has 73. Technology still has a portion called consumer discretionary. That's like Starbucks and Bed Bath & Beyond. As little tech as they sound like they should be, They are NASDAQ 100 components that are not in XLK, which is a little bit more of a purist saying Bed Bath & Beyond, I'm sorry, you're not a tech company. But again, if you look at Apple for the last week and you look at Bed Bath & Beyond, Bed Bath & Beyond for the last week, one of them has done very well and the other one has done nothing. Bed Bath & Beyond is the one that's done very well. This is the deep dive that I'm doing every day. I am trying to find which subsectors of tech are performing. And then once I find the subsector, I find the individual names that are going to perform and try to find those trends in order to capitalize on movement. Finally, I just want to bring up semiconductors because everybody loves them and computers drive our world. Semiconductors have done a great job over the first few weeks of the year. Sat for most of December. No surprises there. Semiconductors have had an incredible run over the last 2 years, really. Why do semiconductors always seem to succeed? Because computers run the world, but also we have to watch, and this is a little free advice, again, more free advice, I guess. Semiconductors tend to be a leading indicator for tech overall. If people are exiting semiconductors, it tends to lead ahead of a greater liquidation in tech. So something to watch here, something to be very mindful of. The trend looks like it's going to resume higher, but if we start getting back into the December range or lower, I'm going to get a little nervous on tech as a whole and have to really adjust my risk management and focus on that rather than focusing on the leverage. All right. A few questions did come in here before I go to the final couple slides here. How do I know if I'm late, if I'm still in the Bollinger Bands? I won't know I'm late until the stock starts to come back down. That's when a stop loss would kick in. That's when I'd get out. So if I start seeing regular support and support levels, I don't have a ton of time to really talk deeply on today, but previous lows, lows of the trend channel, those are supports that I tend to look at. And I want to make sure that I've always got those under control. And do I trade ETFs? I trade the components of the ETFs. I'm trying to outperform those ETFs using a combination of technical analysis and options. And that's how Option Trend Trader works. I use that triple moving average signal I mentioned. Make sure you watch your email so that you can find out how it works. Then I structure my trade using options that expire in 3 to 5 months. These are not short-term options. These are what I call midterm options, a great combination of liquidity and defined risk without getting too far out. If I start going out to like 12-month out options, oftentimes I find the liquidity is bad. I'm giving the market maker too much money. As an ex-market maker, I would never want to trade options that expire that far away because that uncertainty and implied volatility matters that much more to an option market maker. They're going to have to make more money in order to make a trade with me or you. I use 65 to 80 delta options. That means an in-the-money call option. The percentage in the money varies by implied volatility, but you're looking at a stock with an option that's in the money, okay? So that's it. It's pretty simple once I've got the triple moving average, but it's also very complicated in order to try to find that first stock to go on. And that's where, we do this part, trying to grow capital into larger amounts of capital. And I want to show you how I can work for you, how I can provide that paddle when you're riding the current in your canoe. And I will hopefully help you plant the seeds to becoming a winning trader. Again, the option trend trader results speak for themselves, but I'm going to speak for them again anyway. We're talking about returns just under 150% last year, a little more than 3 times the return of the NASDAQ as a whole. Great defined risk, as we can see in the drawdown at the beginning of the year. Most of the performance really comes from finding that outperformance on those individual names within the NASDAQ 100. That promo code, as a reminder, Steve Fox already mentioned it to you guys. It's $1,000 off. That's $1,000 off of $19.97. So we're talking more than 50% discount. Usually when you hear $1,000 off, it's because it's a $5,000 product. When you think about the amount of capital that can be accrued if we ever see the same kind of results as we saw last year, which we never know, it pays for itself rapidly. Excuse me. A reminder on how to just walk you through this, just in case people struggle with it. We pull up our, there it is, Option Hotline website. Just go to optionhotline.com OTT, option trend trader. When you pull up this site, it will take you straight there. You got the monthly cost. Annual gives you a discount already. Add to cart. And once that's done, you just type in right here where it says coupon code amazing year, apply coupon, and lo and behold, the price drops from $19.97 per year to $9.97 per year, and it will renew at $9.97 per year. It will not renew at $19.97 per year. You are grandfathered in at this deep discount. You will not be charged more than $9.97 per year as long as you maintain your subscription. So, with that in mind, let me get back up the slides here so that I can give you my contact information and address any questions from here. Let's see here. Yep, I got the wrong window there. There you go. And we got to get to the end, which is always a pain. I think we've just about made it. Amazing year, final reminder, and then final reminder of my contact information. Questions, please throw them in either the chat box or the Q&A. I want to make sure with Stephanie, I think I addressed the days to expiration I'm buying. Buying puts to control risk is something that I do always consider. That's a hedging strategy. I tend to use the ETF options for the hedge and use in the money calls on the individual underlyings. So that one should be covered here. And my stop loss tends to be on the option more than the underlying. So using the triple moving average, that's a little bit of a long-winded thing to do right now, only because it takes a little bit of time to go through. Take a look at the 5 indicators I use document that's going to get into your email tomorrow morning. If you have questions about the triple moving average afterwards, throw me an email or send me a call and we can talk further. We've got, so do you trade the ETFs? Yes, I covered that. Do I conduct biweekly or monthly member webinars? So we've been discussing adding that to our repertoire. As the interest comes along, I will go to biweekly and monthly member webinars. So far, most of the members have actually found that the content itself speaks for itself, aside from calling me directly. So if the phone calls come a little too heavy, then I'll switch over to adding member webinars in order to try to address the group en masse instead of individuals. Are you seeing any other questions, Steve? Do I have you on, Steve?
Sorry. Yeah, no, I was muted. My apologies. I don't see any more questions in the Q&A, and I think you got to the 2 in the chat. So I think we are set. I think one more just came in.
I saw it at the same time as you. Trade ideas on a weekly basis. So trade ideas can come in a flurry one week, and then might just ride that new current for weeks or months. One of the things that's crucial with my system, because I have options that expire every 3 to 5 months, I always have to roll my positions. So that helps keep me in the positions while also accruing cash. Something that I'm happy to discuss as well with others if they have questions about how I accrue cash on the portfolio. When you have a big move like what happened in March of last year, could have just a flurry of activity. And then when you have just slow times where it's more about just monitoring levels and making sure to stop out of positions before they go awry. Is there a free test period? So we currently do not offer a free test period since we've put such a deep discount on it. We debated back and forth on whether to do a free test period. But if you have more questions about that, feel free to email me and I can try to figure out something there. I'm not sure what we can provide. That's up to the sales guys more so than me. And one more. If I buy this, how do I proceed? So once you place your order, you'll get an email with your username and password. That will then get you access to all of our historical content for the program. If you have questions as you look through it, email me. And then we can talk about how the system works and everything else. But I think that hopefully it speaks for itself. And yes, I do not execute trades. I am not an investment advisor. This would all be up to your own discretion. These are technically educational ideas. All that risk stuff, because of the way that compliance and everything works, none of this is considered a recommendation. It's all considered an idea. You can decide if you want to follow a trade or not, but you need to also talk to an investment advisor if you have questions about that. All right. I think we might be there. Stephen, what do you think?
Are we done? Okay. I think we're done. I will take it from here. Feel free to stay on, Keith, or if you're finished, thank you very much again on behalf of all the attendees. We appreciate it very much. I'm just going to go through a couple of last quick things here.
Yes.
So, okay.
For all, sorry, so I don't screw.
Okay. Great. Couple last things. First of all, here again is wanted to show Keith's option trend trader, and you can get a $1,000 discount. Mentioned also, if you want, you can scan this barcode, and that will get you the same discount. Also going to just very quickly go through the website one more time, and I want to show one thing for sure on the contact, and that is, I didn't mention this the last time, so I want to get down to this very quickly. And that is that we would love to hear from you, and feel free to send us a message, reach out to any of our commentators. But what I really wanted to get to is, if you're having any difficulty receiving our emails, if you sign up and you don't get it, please be sure to whitelist our option hotline emails, and that'll make sure that they get through. And you can actually download the contact card for all of our option hotline commentators, and it's most of this information, which many of you saw before: customer support, trade alert questions for Keith, podcast questions, and then again, sales. Any products that you're interested in, you can do info at option hotline, or this phone number, or info at market education. So any of those will get you there. We do have a calendar of our upcoming webinars, just very briefly.